Okay, looks like it works. Thanks for having me, first of all, and thanks for everyone attending. So yeah, you can see the presentation, that's good. Cool, so let's start first, before we move any further, discuss first with maybe a short clap. Do you know what quantitative finance is? Clap if you know. Okay, two folks. Okay, that's a beginning. So I just know how beginner friendly to go ahead. So given that we have only about 2-3 people who have heard of quantitative finance, I'm going to start with a quick intro first. Okay, we have more people gathering. A quick intro about first myself, and then get into a little bit more of what quantitative finance is. So my background, so you know I'm legit. If after this you still don't think I'm legit, I can switch to a stochastic differential equation lesson. So keep me posted on that one. So yeah, I'm an ex-maths gold medalist. Did compete a lot in mathematics. Interned at Citadel. Was part of main group as a quant. And I've been running myself a crypto Arpagus for about 4 years now. We can get into a little bit more details about that later. And as part of TopCoding in 2025 alone, we've helped 32 plus people land roles at hedge funds and trading, more than 250 plus in total, but we're talking about crypto and trading today. Some of those guys landed 610K, so far you can see that's about the price of a green Lambo, if you've noticed one around. And yeah, let's get straight into it. So because a lot of people came up again with clapping, how many of you guys have heard of quantitative finance before? Clap if you know what quantitative finance is. Okay, not much more people. Okay, so what is quantitative finance? First, on the left-hand side, you can see the back-end office. On the right-hand side, you can see the front-end office. So on the top left, what you see, all these really quirky equations that nobody really understands apart from a couple of Russian, Chinese, and Bulgarian guys, are usually what hedge funds use for sales and not that much for trading. And just below that, you can see that could really be a real code from trading. I'm just kidding. But yeah, and then what you see on the bottom is one chart. What that chart is, everyone probably knows about that, stuff like S&P and stuff. So here the question is, how do we combine these three things into something quantitative, into finance, into crypto, into making money? And going into the right picture, basically. I mean, on the right picture is why most people start into quantitative finance. And what they see eventually is only the top left. But yeah, so quantitative finance basically mixes up mathematics, machine learning, AI, like AI, you know, artificial intelligence, artificial really, and coding, finance, and a lot of hacks, if I can say so. What I mean by hacks? We're gonna delve into one specific type of hacks in a minute. But here, maybe many of you are thinking, can I do that at home? Can I do it? Yes and no. Yes, you can do something. No, it's not gonna make you a millionaire, most likely. So that being said, let's move to the next one. Where basically we're going to get into one of these things that actually makes lots of people millionaires, buys them Lambos, etc., and basically why most people got into. Besides those guys who never heard of quantitative finance and just got in from like some recruiters founding them through some their old friend in a Russian gymnasium. But yeah, basically it was the idea of that basically broke the market many years ago. So people decided, okay, that actually makes sense and let's try this to make more money, is some very smart guy, we don't know who literally created that, but some smart guy at some point said to themselves, okay, if Adam sells an apple for $5 a piece and Anya wants to buy an apple for $5.50, why don't I just buy it from Adam and sell it to Anya and make 50 cents profit, right? It's risk-free. I can do it as much as Adam has apples to sell, or Anya wants to buy whatever is lower, I can go up to that point. And it's same with arbitrage trading, actually. That's what arbitrage trading makes, and that was one of the very first ideas in quantitative finance in general. And currently, all these things run on a like $1 trillion scale in like regular finance, stock market, etc., and on $1 billion scale in crypto and Web3. And actually, what makes it very appalling for the smaller guys to get into arbitrage and other kinds of quantitative trading strategies in crypto is the fact that there are a lot less big people, like big fish, sort of. And why is that? Quickly, let's take Citadel. Citadel, they manage about $60 billion. They make about $30 billion a year profit. And the entire market cap of some of the crypto coins is I don't know, 300 million, 500 million, 1 billion, 2 billion market cap. You can't steal their market cap, right? And if you make, I don't know, 20% off of the market cap, which is also unrealistic, off of I don't know, 800 million, that's 160 million. And that's 0.08% of their yearly profit anyway. So when you have Jane Street, Stamo and all those guys not getting into quantitative finance, you then basically give the chance of regular people, like some ex-quants who've been at some of those companies. You can actually, in Bulgaria, there are a couple of really good companies like that one. Asymptote is one of those. We are not affiliated with them. It's just a nice company. All of them are ex-traders from SAG Trading. And yeah, I started talking about why crypto. But yeah, basically, all these small companies, people with a lot less money, basically, they can get into the crypto trading by themselves with pocket money. I mean, pocket money here would be a couple $100,000, but yeah, on the large scale of things, that's just pocket money. So there is growing market. There are a lot of coins. I don't know how legit the statistics is from CoinGecko, but even if it's not as accurate, even if it's not 500,000 new crypto tokens, even if it's 1% off of that, that's still a lot more than stock market's growth out there. So there's lots of opportunity. There is low competition. We already explained that because all the big people are not in the big companies. And there are large price discrepancies, what we just explained. So a lot of Adams want to buy at, I don't know, $10 per coin, and a lot of Anis want to buy for 12 or 13 or 15 because they saw, oh, this is bullish and whatever. And all these big price discrepancies are actually very, very sweet as profit margins. And why do they exist so much? First, because there are lots of basically exchanges, and all of them are unregulated, a lot of them. Or if there are any regulations, it's far from being as regulated as the stock market. So basically, anyone can jump in. There is no high trading volume, etc. So what you will end up with is actually lots of price discrepancies, which is very appetizing. Of course, the downside is there is not high volume enough. So if you want to make 20 million a day, you're probably not going to be able to. But for the people in this room, probably 20 million a year or their lifetime would be perfectly fine. So that's what we're in general targeting. So that's perfectly fine. And all these large discrepancies, even with bad code and without a lot of, I mean, when I say bad code, don't think of ChatGPT code or something. We're talking about code, maybe one of the best codes written in Bulgaria. That's what bad coding in trading is usually. But yeah, still with not I mean, for example, the time to blink your eye is 300 milliseconds, and the differences in speeds on the real stock markets are usually 2 microseconds. And that's 2 millionth of a second. That's fast. So yeah, you don't need to be as quick. You can literally have a delay of I don't know, 50 milliseconds and still be fast enough. And the nice thing is you don't need to be the fastest. You just need to be faster than one person. So even if the fastest is too fast, you can only need to run out by one person. So yeah, that's why it creates a lot of opportunity in crypto. That's why quantitative finance is vastly integrated into crypto. And that's actually what makes it possible for us also to buy. Because when you go to the market and you say, okay, I want to buy 1 Bitcoin, whom do you buy from? You don't buy from me or you or someone else. You buy from a company, usually that's a market maker. And there are a couple of market makers also in Bulgaria, one of them, I believe, RavenDAO. I think there might be here as well. I think they do that also. What else? I forgot. There are a bunch of companies doing that. So there are some nice companies. Also, there are a lot of undisclosed ones where people just do it from basically their home, like my arbitrage cryptos, which no one really has heard of, but doesn't really matter, and I don't care. And you don't have to. Anyone can do that at home. I don't say it's going to work. It's not financial advice. Under no way. So here, maybe you're thinking, okay, how to become a quant and do the same. First, there are three types of quants. There are the quantitative researcher, developers, and traders. So first of all, what's the difference at all? Researchers, those are basically, I don't want to yeah, those are PhD guys. Okay, so those are PhD in mathematics, machine learning, and stuff guys. I was a researcher for a while, and it's exhaustive. It's usually doing like 13, 14 hours a day of research and finding new stuff. So those are AI PhD guys, mathematics PhD, ML PhD, etc., computer science PhD sometimes, depending on what kind of area you're focused. So probably not one of those. You don't need to like find new stuff out there. There are the developers, which is pretty cool role. I was the longest time into a quant dev role, which is basically the part where you get the research that's already done, you connect to the right places, and you basically do the entire algorithms and run them to glory, as I like to say. And the quantitative trader, that's a very peculiar role. It's somewhat diminishing in recent years because those are the people who manage the algorithms that already trade on the market. So when you have, let's say, 3 arbitrage algorithms, one of them trades Ethereum and Bitcoin, one of them trades Solana and Bitcoin, one of them trades BNB and Bitcoin, for example, the trader is the one who decides, let's say, how to reallocate the capital around the tree, whether to turn down some of the alphas or increase. They're like the entire Greek alphabet is included in quantitative finance for some reason. But yeah, Greeks, betas, etc. So the trader is the one who decides all of these things. Why are they diminishing? Because a lot of these things now become quantitative as well. And in the past, it used to be very hard because you have like large context, but now all of these can be shoved into algorithms and produce the most optimal outcome. There are still some roles, of course, because you don't want a portfolio of like 5 billion being only attended by machines. You want to be someone to be able to literally like switch it off from the electricity and stop trading if something goes off. This is actually, by the way, this is a fun fact. A lot of the hedge funds use literally turn off switch from the electricity to turn off their computers, and the reason is it's reliable. That's the answer. You know, when you switch it off, it's reliable, it's stopped. You can't keep trading if it's switched off. So literally, like Jane Street's a $40 billion trading company. They literally trade 40 billion of their own money. They literally like switch it off at the end of the day. So they're certain nothing trades. But yeah, sometimes you want to be certain and not be like fancy because like there's a trade-offs. I don't think some of those hedge fund managers want to wake up and see, oh, our fancy thing lost 500 million. I prefer to be old school and safe. So that's about the 3 different things. My story, yeah, I was a quant researcher, mentioned that for a while. Then I realized, okay, that's fun, but the dev roles have a lot more different things and aspects that they can touch base to. Did a little bit of trading, especially in the Citadel company, but yeah, we went through point 2 as well. And the proven formula that at TopCoding that over the past 5 years has produced hundreds of quants, it's first, if you don't have a good enough background, which means you didn't do some bachelor's in mathematics, CS, etc., and you didn't really focus on those stuff, you really need to get started from the ground up. If you spend, I don't know, if you're like 25 or 30 now and you've never studied CS or maths, etc., probably it's going to be close to impossible for you to get into the research or trading or quant dev. Why? Because those guys literally buy out the base devs out there and they literally pay the highest salaries out there. I mean, if OpenAI started paying like 900K a couple of months ago, at hedge funds you can make 2 million for the past like 30 years or so. Now you can make a lot more. For example, at TopCoding, if you stayed more than 3 years, you're certainly 1 million plus package. So they just buy the top talent. And literally, for example, even at Main Group, when we started hiring a couple of years ago in Bulgaria, the first people that we hired were actually, we hired 3 people out of 2,000 resumes. So it's competitive. And yeah, the formula is don't try to jump off the cliff if you don't have long legs, basically. That's one of the formula. And then if you go through all of this stuff, then you can potentially have the chance to get there. But guys, still pretty tough. And okay, 1 second, wrong slide. And yeah, so, but still, That shouldn't like disappoint someone or make them believe they can't do that, etc. But the first step is always information. If you don't have like information, what's that, what that looks like, you're probably never gonna make it. So just start by exploring, be open and interested. There are a ton of videos nowadays on YouTube. You can go watch all of these, look how people like code trading algorithms. It's not that they're gonna work, but it's something. It's also always a start. If you wanna be like Olympic runner, you don't start by running on the Olympiad, right? You start running in front of your block, so it's still something. And yeah, that's certainly viable for anyone to get into, to feel about it. And if you want to like really get into this kind of like career and stuff, basically try to find a couple of trampoline companies, maybe getting into a bank first or an analyst position or data science. And with time, if you progress fast enough and you go through the right places and you try to jump over and over to a better and better company, eventually you might be able to actually make it into a nice one. And yeah, you can always experiment at home and stuff. So it's Q&A and the end time with the left like 1 minute. And yeah, did you guys enjoy that? Okay, cool. Thanks so much. And now on the stage, some other guys from the same city where I was born in are gonna welcome us. So thanks so much again and see you later.